Investing can feel overwhelming with so many options out there. But don't worry, I'm here to guide you through the most common investment instruments, ranked from the most beginner-friendly to advanced. Whether you're just starting out or looking to level up or diversify your portfolio, this video has something for you. Let's dive in. Let's start with the easiest and safest options for beginners. These investments are simple to understand and come with low risk. They're also great for experienced investors looking for security and stability. First, we have savings accounts. What are they? They're deposit accounts offered by banks or credit unions that pay interest on your balance. It's the simplest way to store your money securely while earning a small return. Risk? Extremely low. Your money is insured such as through FDIC in the US or FSCS in the UK. How to start? Visit your local bank or open an account online. Many banks now offer no minimum balance accounts. Savings accounts are perfect for preserving capital and accessing funds easily when needed. Next, we have certificates of deposit. What are they? A time deposit where you agree to lock up your money for a fixed period in exchange for a higher interest rate. Risk? Very low. Your principal is protected, but there is a penalty for early withdrawal. How to start? Speak to your bank or credit union. Choose a term length, such as 6 months up to 5 years, that matches your financial goals. Certificate of deposit are a secure way to earn higher interest on savings, which can help supplement fixed income. Next, we have bonds. What are they? Loans you give to governments or companies in exchange for regular interest payments and the return of your money at maturity. Risk? Low to medium. Government bonds like US Treasuries or UK gilts are safer, while corporate bonds carry higher risk but offer better returns. How to start? You can buy bonds through a brokerage or directly from the government's website in some countries. Bonds are often used by more experienced investors as a source of steady income, particularly government and municipal bonds. Next, we have ETFs or exchange-traded funds. What are they? A collection of investments, like stocks or bonds, that you can buy and sell on the stock market. Most ETFs track indices like the S&P 500. Risk? Moderate. Risk depends on the type of assets the ETF holds, but is generally diversified. How to start? Open an account with a brokerage like Vanguard, Robinhood, or eToro. Some banks also offer an option to invest in ETFs like BlackRock iShares or Vanguard ETFs. ETFs offer an easy way to diversify and can include low-risk options like bond ETFs. Next, we have robo-advisors. What are they? Online platforms that use algorithms to build and manage a portfolio for you based on your financial goals and risk tolerance. Risk? Low to moderate. Risk depends on your chosen portfolio strategy. How to start? Sign up on platforms like Betterment, Wealthfront, or Nutmeg. Answer a few questions, and they'll do the rest. Robo-advisors provide a hands-off way to manage investments and align them with your goals. Once you're comfortable with the basics, it's time to explore slightly more complex options. These require some research, but offer higher potential returns. Many of these can also appeal to more experienced investors seeking income or moderate growth. First, we have dividend stocks. What are they? Stocks from companies that share a portion of their profits with shareholders on a regular basis. Risk? Moderate. Dividend-paying companies are usually stable, but stock prices can fluctuate. How to start? Use a brokerage to identify dividend-paying stocks. Look for metrics like dividend yield and payout ratio. Dividend stocks provide a regular income stream without requiring you to sell your investments. Next, we have REITs or real estate investment trusts. What are they? Companies that own or finance income-generating real estate. You can invest in them just like stocks. Risk? Moderate. REITs offer diversification but can be affected by economic downturns. How to start? Search for publicly traded REITs on your brokerage platform. Look for ones with consistent dividend histories. REITs offer an easy way to invest in real estate and generate passive income. Next, we have individual stocks. What are they? Shares of individual companies that you own directly. Risk? Moderate to high. Individual stocks can be rewarding but require careful research. How to start? Open a brokerage account and research companies using metrics like PE ratio, growth potential, and market trends. For those with investing experience, Individual stocks allow for targeted growth strategies. Next, we have corporate bonds. What are they? They're debt securities issued by companies to raise money, typically offering higher returns than government bonds. Risk? Moderate. Risk depends on the company's credit rating. How to start? Use your brokerage to find corporate bonds rated investment grade or higher. Corporate bonds can provide higher income while still being less risky than stocks. Next, we have crowdfunding real estate. What are they? Platforms that pool money from multiple investors to fund real estate projects. Risk? Moderate. Returns depend on the success of the real estate project. How to start? Explore platforms like Fundraise or other crowdfunding platforms. Start with a small investment and track progress. This allows for real estate exposure without the hassle of managing physical properties. For seasoned investors, these advanced instruments can offer high rewards but also carry significant risk. First, we have options. What are they? Contracts that give you the right, but not the obligation, to buy or sell an asset at the specific price by a certain date. Risk? High. They require a solid understanding of the market and timing. How to start? Learn the basics of options trading through tutorials. Most brokerages require approval for options trading. Next, we have cryptocurrencies. What are they? They're digital currencies like Bitcoin, traded on blockchain platforms. Risk? High. Cryptos are highly volatile and speculative. How to start? Open an account on platforms like Coinbase or Binance. Research the technology and trends before investing. Next, we have futures contracts. What are they? Agreements to buy or sell assets at the predetermined price in the future. Risk? High. Futures can amplify gains but also losses. How to start? Use platforms specializing in futures trading. Practice using demo accounts before committing real money. Next, we have forex trading. What is it? The trading of currency pairs, such as Euro to USD, to profit from changes in exchange rates. Risk? High. Forex trading is highly leveraged, which means both potential gains and losses are magnified. How to start? Use platforms like MetaTrader or brokers. Start with a demo account to learn the basics without risking real money. And then we have hedge funds. What are they? Pooled funds managed by professional investors, using aggressive strategies to maximize returns. Hedge funds invest in a mix of assets, including stocks, bonds, derivatives, and private equity. Risk? Very high. They are typically unregulated, highly leveraged, and accessible only to accredited investors. How to start? Hedge funds are usually for wealthy individuals or institutions. If interested, you'll need to meet the income and net worth requirements and research funds that align with your goals. And there you have it. Investment instruments rank from beginner-friendly to advanced. No matter where you are in your investment journey, there's always a way to grow your financial knowledge and portfolio. The key is to start with what you're comfortable with, build confidence, and take small steps toward more complex strategies. Whether you're a young professional or an experienced investor, there's an investment that fits your needs. If you found this video helpful, make sure to like, share, and subscribe for more financial tips and insights. Let me know in the comments which investment instruments you think are best to invest in.